Hello traders, welcome back to the Forex gig where we dive deep into the tool that can help you make smarter trading decisions. In today's video, we are going to be talking about the double stochastic strategy, a powerful method that combines two stochastic oscillators to give you more accurate signals for entry and exit trades. This strategy can help you identify overbought and oversold conditions with greater precision, reducing price false signals and improving your overall trading performance. So stay with us until the end of this video as we would cover everything from setting it up to applying it effectively in your trades. Let's get started. Now, how do we understand the double stochastic strategy? You first need to know what a stochastic indicator is. A stochastic oscillator is a momentum indicator that helps you determine whether a currency pair is overbought or oversold. It does this by comparing the closing price of an asset to the price range over a specific period in time. This tool is especially useful for identifying po ten tial reversals in the market. Now, the double stochastic strategy takes this concept one step further by using two stochastic oscillators instead of one. We are making use of a fast stochastic and a slow stochastic oscillator. The fast stochastic oscillator reacts quickly to price changes, making it great for spotting reversals or spotting short-term momentum. On the other hand, the slow stochastic move makes steady, helps you to confirm trend and avoid reacting to false signals. Now, how do we set up our double stochastic oscillator? The fast moving oscillator is this one over here. How we set it? We use settings of 8, 5 and 3. We use settings of 8, 5 and 3. This means the indicator will calculate based on an 8 period range with smoothing factor of 5 and 3. While the slow stochastic oscillator makes use of 14, 7 and 3. This uses a long period of 14 period range with smoothing factor of 7 and 3. These settings actually allows the fast oscillator to pick up on quick market movement, while the slow oscillator filters out noise and confirm valid signals. Once you have set up both oscillators on your TradingView platform, you notice that two lines are on each of the indicator, this yellow line and the blue line, which is the percentage K and the percentage D. This line represents the current value of the oscillator, which is the percentage K, and its moving average, which is the percentage D. Crossover between this line are key signals for this strategy, which we will discuss in details in the next section. By understanding these two oscillators completely and how they complement each other, you are already one step closer to mastering this strategy. So let's move on to how we can use them effectively for our trading decisions. Now we understand how the double stochastic oscillator work. We are going to dive into how to use it to make informed trading decisions. The strategy focuses on identifying entries and exit points by analyzing the crossover and positioning of the fast and slow moving oscillator. When trading with the double oscillator, you would want to look for opportunities in both overbought and oversold areas. For the overbought zone, we have to look for areas above 80. When both oscillators are above 80, and at this point, look at the slow one is above 80 in this region. In this region is above 80. The fast one is above 80, as we can see. It indicates that the market may be overbought and look for a crossover where the K line crosses below the D line. In our oscillator, this suggests a potential selling opportunity and price might start to reverse. This is for the overbought zone. Now for the oversold zone, we have to look for areas below 20. We look for areas below 20. Conversely, when both oscillators are below 20, when areas are below 20, the market may be oversold. A crossover between our K line crossing above our D line signals a potential buying opportunity. As we can see, if we see this crossover at this area, when the K line crosses above the D line at this particular area, it signals that price is about to go in the bullish direction because price has been oversold. And at this area, at the fast moving stochastic oscillator, we can still see a crossover in this area, and we can see price is trading at the 20 level, showing that it's an oversold zone. Now, how do we exit our trade? We have to exit our trade. We have to use proper exit strategy because they are crucial for managing risks and securing profits. Stop loss should be placed just below or above recent high. If we took a trade at this area, if we took a buy trade at this area because of our indicator crossover, if we took a buy trade at this area after our signal, if we took a trade at this area, our stop loss should be below the previous low or high, or below an area of low or high, swing low or swing high zones. This area, in case of a buy trade, should be a swing low. Then in case of a selling trade, it will be above the swing high. We put it below this area to protect our entry against any unsudden or unexpected price movement. Then where do we place our stop loss, our take profits? We determine our take profit based on a favorable risk to reward ratio. We can target 1:2 or 1:3 as the case may be. This is to ensure that you lock in profits while minimizing your potential loss. You can also take profit at support or resistance area. We also need to choose time frame and currency pairs for this double stochastic oscillator strategy because it works best in a certain condition. Time frames that we can choose, we need to consider using this strategy on the 1 hour or the 4 hour charts for swing trades. This time frame provides a balance between capturing significant price movement and avoiding unnecessary losses. As we can see on the 4 hour chart, if I switch to the 4 hour chart, you can see that the line becomes a bit smoother. So when we are trading on a higher time frame, the 1 hour and the 4 hour time frame, we will see that we would capture significant price movement and will avoid unnecessary noise in the market. The currency pairs we should focus on are the currency pairs with high volatility, such as the GBP USD or the Euro USD. These pairs tends to exhibit clear trends, making it easier to apply this strategy effectively. By following these guidelines, you can enhance your trading decision using the double stochastic strategy. Remember, practice makes perfect. So backtest this approach on a demo account before applying it on the live market. Alright traders, we have come to the end of this video. Engage with us in the comments below. We want to hear about your experiences. If you found this video helpful, do not forget to like, subscribe and turn on your notification bell so that you wouldn't miss out on more trading tips and strategy. Thank you for watching, and I will see you in the next video.